So this week we're going to look at QE. We've talked about it before, but it's interesting how central banks now are trying to unwind their balance sheets after having driven up massive balance sheets because of QE. Well, first of all, during the global financial crisis, and then, of course, enormously so during the pandemic, when they had no choice but to buy government bonds because governments were spending money and nobody was really doing anything else. So, for example, the US purchased $3 trillion in bonds in 2020, the Fed. The UK, close to £500 million by the Bank of England. Australian bond purchases were averaging over that time about $5 billion a week. So the size of central bank balance sheets mushroomed during that time. But Steve, if nobody wanted to buy those bonds, and I guess they wouldn't have done during the pandemic, it would have been seen as being too risky. It was a good way of getting money into the economy. Or do you think actually people would have bought them because they were? That was the rationale behind it, though, wasn't it? You think people would still have bought them?
No, the QE is an indication of just how mentally bankrupt mainstream economics is, because they follow mythical models about how banks operate. That's fundamentally what's going on here. And like the most recent, we've got to raise this straight away. The IMF has come out with a recent report saying that they recommend Italy to run a 3% of GDP primary surplus to get its economy back in shape again. Now, the shape it will get it into is basically that of a corpse. It is a sign of just how completely bereft of knowledge of the financial system the dominant models that economists use to direct their policy is based. And that comes back to QE, because if you look at the rationales for QE, one of them made sense. It did actually have the effect they thought it would have. But the other reason for QE was they thought that if they gave, when the central bank buys bonds, it does that by putting a positive entry in the reserve accounts of banks at the central bank. That's how it actually pays for the bonds. Now, if they're buying it off a bank, that means that you look at the bank balance sheet and the amount of bonds that the banks go down, but their reserves go up. So what happens is that's where the other side of the coin for the massive central bank holding of government bonds is massive levels of reserves in the private banks. Right. Now, that just changes the asset that backs money. It doesn't create no money. But the thing they do which does create money is that when they buy bonds off non-banks, that credits the deposit accounts of the non-banks, which they have at private banks, and it also increases the reserves. But because it credits their private bank accounts and their financial institutions, it gives them money they can only legally use initially to buy assets. So QE massively increased asset prices. And the fun thing about reversing them now is that if the central bank is now selling those bonds back to the private sector, then one way they're going to be financing them is by liquidating other assets. And that's going to be real fun.
But the argument wasn't it? And I take your point. If it's all just going into bank reserves, it makes no difference. But presumably, they realised that, but they weren't just buying from commercial banks, were they? They were buying from.
Oh, they're buying.
Pension funds.
When you read the minutes of the Federal Reserve, they literally, quite a few of the members, Plosser in particular, but also Bernanke, thought that by increasing reserves, they'd increase private bank loans, or bank loans by private banks to companies and households. And that's what caused the bloody crisis in the first place, with which they were completely unaware because they ignore private debt. They never included it in their thinking. And it's the last thing you needed was to restart the bubble. And of course, the other thing is you can't lend out reserves. I'm having this bloody argument with neoclassicals who I think I'm going to cease saying neoclassicals and call them Neanderthals. That's closer to it. They simply will not consider that their model of banking is wrong.
When will you be nice, Steve?
They had
even. I'm going to say, when are you going to be nice to Steve? Let's just be
never.
Okay,
I've given up.
Cranky old man. That's what you are.
The lead chapter of Debunking Economics is No More Mr. Nice Guy, and I realised I wasn't rude enough, so I'm going to get worse over time. So wear it.
Okay, but look, even if that was the case, even if they believe that by pushing more reserves into commercial banks, those banks would lend out more, which, as you say, is a falsehood. They wouldn't be thinking that during the pandemic, would they? Because no one was borrowing anything. So the whole point of QE during the pandemic was to have a mechanism to get money as fast as possible into people's pockets because people weren't working, and so the government could do that through furlough, and then they just needed to issue those bonds and have those bonds bought up to try and cover the cost
in that
of
case,
furlough.
it was a support policy for government deficit spending, and that's what bond sales basically are. So they've got to sell the bonds to the private sector, and then if the central bank the central bank is basically irrelevant to that issue because it's the actual fiscal decision to run a deficit by giving people pay directly, and that's what happened during QE. It's amazing how fast people forget what actually happened during the pandemic. But in the American case, there was direct payment to people, which was made up for the fact that they lost their salaries, and quite a few Americans got a larger payment from the government than they got on their salaries. So there was actually a boost to aggregate demand from fiscal policy during the pandemic. And then because you're doing fiscal policy, which means you're spending more than you're taking back in taxation, your spending exceeds taxation, you're required to issue bonds, they're supposed to be sold, and then if the central banks bought bonds at that particular time, it's largely irrelevant to the initial impact, which is when the government runs a deficit and puts money in people's deposit accounts, that actually boosts the amount of money in the economy directly, and that's what enables the spending to be high during the pandemic rather than low. The QE was but largely irrelevant.
Well,
to that.
except that if they hadn't done QE, then they'd be issuing bonds out into the market, which would mean that money that's just been created, they'd be taken out again, wouldn't they? If it was a money extraction.
Yeah, that's right, and that's the important point. Yeah, when you sell bonds to the non-banks, with primarily financial institutions, but also to wealthy individuals buying the bonds, then that's taking money out of circulation. So the central bank buys those bonds back. That reverses what the banks do, because when the banks sell bonds to non-banks, it actually destroys money created by the deficit in the first instance. And the scale of this is quite huge. So a reversal at that time is quite significant. My good friend with the weird name Richard Vague, least vague man I've ever met. Richard's research team looked at the level of government money creation and destruction between 1980 and 2024, and they concluded between 2020 and 2024, which of course includes the pandemic, 91% of the money created was created by the private sector. So all the government money creation, bar about less than 10% of it, was reversed by things like private banks selling bonds to the non-bank public. So during QE itself, specifically reversing that, yes, that means that money turns up that otherwise would have been destroyed by the sales by private banks of bonds to non-banks on the secondary market.
No, I'm not quite getting you there. So during those years that followed the pandemic, and the pandemic was still trailing on through 2020, 2021, we still had furlough over those years. There was still money going into the economy by the government that were being issued in bonds that were then very often being bought by central banks. So the money expansion came from the government, and then to ensure that it wasn't negated by those bonds being bought up, the central bank would buy it. But also there would be. So I'm not quite. We're not quite sure how the private sector was adding to the money supply in that circumstance.
Well, what you're getting is the private banks. I mean, this is why you've got to do the double entry bookkeeping, and it's why I get totally pissed off with neoclassicals being unwilling to, even look at my Ravel software, which is the only thing that'll let them do that. But when you have the initial sale of bonds by the Treasury through primary auctions conducted by the central bank, just changes the asset backing money. It doesn't change the amount of money created by the deficit itself. But when the banks then sell those bonds on the secondary market, the bond market, that cancels private money creation. So if the central bank then does the opposite and buys those bonds back off, that restores the money creation that private bank sales have cancelled. So it did make sense at that stage to put the money. And the trouble is the only place that the central bank can put that money when it buys bonds off the private sector is either into financial institutions, which are required to buy assets with that money, or wealthy individuals who will buy assets with that money.
Yeah.
So it inflates the financial sector. It doesn't really inflate the real economy.
And when they were buying up those bonds, because there were so many of them, I mean, you would have thought if there were loads of bonds being issued, then the price of bonds would go down and that would push interest rates up, which would be a concern at a time like the pandemic. But actually what was happening, even though they were doing that, bond yields were going down because irrespective of how many were being issued, there was such demand because it was the only safe place to put your money during the pandemic.
That's right, the safe asset effect.
Because we didn't know whether we were going to survive or
And
not.
also the return of money to America during a crisis America caused. You know, it's a safe haven. You go back to the safe haven where the robbery first occurred.
Right. So central banks, though, built up these massive balance sheets. So it got up to £1.1 trillion for the Bank of England by the start of 2022. Then it started declining. It got down to almost, it's now about 800 million. So that's over 200 million.
Million or billion? Million or billion?
So billion, I should say. Yeah, 1.1 trillion down to that would be quite an unwind, wouldn't it? For 1.1 trillion.
That'd be a huge plunge. Yeah, we would have noticed that one on the stock exchange.
So for 1.1 trillion down to 800 billion, which is pretty much where we are now.
Yeah.
So do we have any idea who's buying those bonds? Are they just going back into the reserves of the commercial banks, or are they being bought by the private sector? Do we have an idea? Because obviously that has a determination of the impact on the money supply.
You would be able to get that data, but the fundamental thing is people who buy, there are only two major groups that buy government treasury bonds. One is financial institutions in general, pension funds, superannuation funds, insurance companies, vampire squids, etc., etc. They all buy them, and then wealthy individuals. At one time when I was not a wealthy individual, I bought $200,000 worth of Australian government bonds, Queensland state bonds, as it happens, to take advantage of my expectation of falling interest rates, because I refused to speculate on the property market. My mistake. I should have chosen the bigger bubble, but I did come out ahead on that particular purchase. So you can buy bonds, but the main people who are buying them, particularly the high yields that apply now, are the wealthy. And the thing is, what do the wealthy do with the money they make? They buy more assets. So the whole thing pumps up the asset markets. And the fun thing about this attempt to reverse it is what might happen to asset markets when the part of the cash flow disappears.
Yeah, which is not what we want right now. Given that we've already seen that widening rich-poor gap during the pandemic, because some people weren't able to work and some were, and just the growing movement of money into the finance sector. So to escalate that by pushing more of this money that's sitting in central banks doesn't seem like the opportune thing to do. So why wouldn't a central bank like the Bank of England say, yes, we've got a big balance sheet, but what does it matter? Let's just keep it where it is right now.
Exactly. That's what I think they should do. The whole, it's partly, the extent to which economists who believe they're rational are slaves to conventional behaviour, both in the definition of economic theory, but also in their historical role. Before the global financial crisis, the usual level of reserves was almost zero. And you look at in terms of the level of reserves held by depository institutions above the requirement at the time was effectively divided by GDP was 0% of GDP. Then the financial crisis hits and it goes to 20 and 30% of GDP. And I think, we should get back to the old level where we can do what they call corridor guidance to buy and sell bonds using open market operations to maintain the target rate around the level they want. With that scale of reserves in existence, that's no longer feasible. The reason for doing open market operations was to provide financial institutions with sufficient reserves to buy the next auction whenever that came up. But at the moment, I did the numbers for Britain recently, and the level of excess reserves, or a reserves period, because there are no requirements anymore, the level of reserves was roughly equivalent to 30% of GDP. There are roughly 100 auctions per year. And so with deficits of less than 10% of GDP, that means about 0.1% worth of GDP of bonds is issued is on the table at every auction, and the amount of funds that are available to buy it, 300 times that. Curiously, the same ratio applies to America. Different frequency of bond auctions. They have basically one a day. And the same basic story rolls out that there's 300 times as much reserves as actually needed to make sure the next auction will be fully subscribed. So it's a mess, and they're trying to tidy up their room, and and it doesn't work. That's basically what I regard them doing.
But
at the moment.
if they do sell it off and it goes into banks, and banks have too many reserves, too much in the way of reserves. I mean, if you can have that, I mean, does that matter? Well, I mean, what are the implications of that? I mean, rather than a big balance sheet sitting with the central bank, you just have a lot of reserves. I mean, the only difference I can see is that this crazy idea that the government is paying the central bank the interest on the bonds that they hold, only for the central bank to then say, thanks, here's that money back again. That money would go to commercial banks rather than to the central bank. So that would be the only difference. Well, I mean, what's wrong with banks holding big reserves?
Nothing. And frankly, I think the more I think about the disaster we've had, economic instability for the last 50 years, when, of course, neoclassical economists promised us stability, equilibrium, and full employment, anything but's been delivered. It just shows that the current system, particularly when it's being managed by neoclassical economists who don't understand the monetary system, is mangled. And we'd be better off letting the central bank buy all the bonds, which means that there'd be reserves piling up at the private banks, which they can't trade, and they can only get rid of them through international trade or through people making cash withdrawals. They've had massive reserves and pay them interest on that to reflect the costs of the banks maintaining the payment system. That'd be my preferable system. So whatever the deficit is issued, either the central banks buy the bond directly off the Treasury, or they buy them on the primary auction by the lot, and then that means all the private banks end up reserves, which they therefore can't sell into the bond market because they can only sell bonds. It'd force them effectively to stop reversing government money creation, which is what happens when the private banks take those bonds and sell a lot of them fundamentally, which is what they've been doing, to non-banks, particularly the financial institutions and the vampire squids. So this would basically make the system work less badly than it currently does if the central bank held the bonds and the private banks had the reserves.
Right, but the whole of the finance sector, your pension fund, everyone's pension fund, has got money in bonds because that's the safe asset.
I know, and I would love to see the reaction because the people who are complaining most about government debt these days fundamentally are economists in the financial sector and mainstream economists. And it's terrible, all this government debt. It's terrible, all this government debt. Oh, you've bought all the bonds? We need some government debt. We need some government debt.
They will be the people who will be choosing the safe option in their pension plans, that's for sure. So they will be the people reliant on it rather than equities,
Yeah. So the bond market is gigantic. It's fed by the banks selling the bonds that they buy in the primary auction to the financial institutions. And they're the source of this misinformation, one of the major sources. All right, well, let's get the right information. Let's take the bonds away from you and see what you've got to say about bonds after that experience. Yeah. So, I mean, I'm being a bit, I can afford to be. This is brinkmanship when I don't have any control. But the fundamental point is that the banking system has mangled. Banking system has the possibility of reversing government money creation by selling the bonds into the secondary market, and we shouldn't let that happen. So, in my youth, the Australian government used to have a rule that 28% of bank bonds bank assets had to be government bonds, local and general. That meant 28% of money creation couldn't be reversed. So let's go back to something like that. Require banks to have, say, 50% of their assets in bonds. And then they therefore couldn't sell them onto the market, and that therefore means they're not reversing the money creation caused by the deficit in the first instance.
But with this sort of like quantitative tightening that we've been seeing from the Bank of England and all the other central banks as they're trying to bring their balance sheets down, I mean that's money that they are trying to basically pull out of the private sector, aren't they? They're basically saying, yes, we're going to sell these bonds out now. We don't want them to be held by banks. We want them to be held by the non-bank sector, because we want to reduce the money supply. Presumably, is the strategy, or they're just scared about holding a big balance sheet.
Yeah, I've given up trying to diagnose the minds of neoclassical economists on things like that. But fundamentally, if they are selling the bonds to the non-bank financial institutions and to wealthy individuals, then they've got to sell the bonds to them at a discounted price that makes the transaction attractive, which they can easily do. And then when they do that, there's two ways that the institution can survive. They can use their own cash reserves they have at the private banks. And if those cash reserves go down, not cash, but deposit accounts, then that also will cause reserves to fall. So that's one possible way it could be done. But quite possibly they're going to sell other risky assets.
Yeah.
And if they start selling shares and property, it could be fun on the finance markets. Thank you, central
because
bank.
they got the chance to buy more safe assets once again. Yeah, and they're going particularly in the time when the economy is not looking so strong. So the UK money supply, just some figures to put behind that, from January 2020, it went from 2.2 trillion to 3.2 trillion during the pandemic. And then by 2023, it had slid back to 3 trillion. So from 3.2 trillion down to 3 trillion. So, okay, 2.2 to 3.2 is a lot, an extra £1 trillion in the economy. But then it's losing 200 billion of that. That's a 2.5% drop in the money supply in a relatively short space of time. Now, that it will have increased at a time when the velocity of money was so slow because no one was spending anything because of the pandemic. But as the velocity picked up again, all of a sudden we're pulling money out of the economy. I mean, that's a problem, isn't it? No wonder the economy wasn't going anywhere.
Yeah. To me, it's a sign of if neoclassical economists running the monetary system, I don't know, it's a bit like having sloths, hiring sloths to fly planes. You've got entirely the wrong people at the controls, and the consequences of what they think they're doing will be almost the opposite of what actually occurs. So, I'm not predicting a stock market crash, but one potential way this could go is to deflate the financial assets that QE initially inflated. And that could be real fun on finance markets, particularly there's a lot of levered borrowing going in there. And we know that margin debt is at the highest level since the Great Depression, since 1929. So there's plenty of potential for for this to lead to unintended consequences of winding up the ownership of risky assets to buy the safe asset that the central bank is now flogging back to the non-bank financial institutions.
And yet, they are winding back those balance sheets. The central banks, they are pushing these bonds that they've purchased back into the open market, and yet equities are continuing to rise. Hitting all-time highs almost every single day in the United States.
Yeah, that which reflects the level of leverage there. The margin debt's a major part of the level of asset prices, but also the government's still running large deficits. I mean, this is one of the ironies. All the talk about reducing the deficit. Remember Musk, and slashing government spending and getting rid of 3 or 4 trillion. I think the scale of government spending in excess of taxation is now larger than it was when Trump came to office. So there's more government money turning up. And a lot of that is ending up, given the overall mechanics of government finance, ending up and driving up asset prices. There's some very good work by a guy called James Young, by the way. I recommend people to check him out on Twitter, doing empirical work to find the link between credit and economic activity. And that's what you're finding. The asset price rises are often driven by fiscal policy moving in the same direction. Same cases being made by Doug from Applied MMT. So if you basically got government policy going in two directions. What the central bank is doing should be deflating asset prices. What the Treasury is doing is inflating asset prices.
That's always the way, though, isn't it? Central banks are working against the economic policy of the government. I mean, they're trying to...
Yeah, it's like a runner who enjoys tripping over its own feet.
Yeah, exactly. All right. Well, look, when we come back, let me tell you about an argument I had on TV, which actually got me to think about, this would be a good thing to talk about this week, talk about QE, because there is a common misunderstanding, I think, about the way it works. So we'll do that when we come back on the Debunking Economics podcast. So, Steve, I was watching a piece on Sky News. Actually, interestingly, just a mainstream news channel spent 9 or 10 minutes talking about quantitative easing. And big concern that they gave. This was the argument that because of all of this unwinding by the central banks, all this money, all these assets are being sold. All of these bonds are being sold at a loss. So they are being
Yes, yeah, I saw that one.
yeah. So
Conway,
yeah,
yeah.
that's right. And the argument was that this loss that's being made is having to be paid by the government. So, and it's such a large amount of money that we're talking about, that is money that the government has to stump up from somewhere. So it's money that can't be spent on health or education. And, it's going to be, the net effect is they're probably going to have to put up taxes to pay for the discrepancy in the prices that have been, they've gained from selling those assets. I mean, is he right? Is that the way the system works?
No.
Right.
No, I mean, Tyrone Keynes has done I haven't had a chance to watch it completely, but Tyrone Keynes did a very nice piece yesterday on what's wrong-headed about this. The central bank is not a private bank. The central bank that gets into negative equity is bankrupt. It literally has to be folded. There's a very good paper by the Bank of England, by the main author being Bolat, B-H-O-L-A-T, for those who want to do a bit of research, arguing that central banks don't have to have positive equity at all. They can actually have negative equity. So the consequences that would destroy a private bank, the central bank can take in its stride, because just like a private bank can create money by creating a loan on one side of its balance sheet and a deposit account on the other, but it has to maintain positive equity throughout its operations, and therefore asset price bubbles can destroy a private bank's financial viability. The central bank's got a limitless capacity to do exactly the same thing, and it doesn't have to have positive equity. So they can take losses on things like this, and that in effect is an injection of money into the private sector when that happens. So they do not have to make a profit. And a lot of Conway knows his stuff about the material world. It's time he had a look at the money world and understood that as well as he understands material production, because his stuff and I've made a couple of comments of this on YouTube coming up recently, he's completely misleading because he's echoing mainstream economic thinking about how the financial system operates, and it's false.
So they sell. So what happens? They sell their assets, they make a loss, they really don't care. How does it appear on their balance sheet? It just appears as another cost on their balance sheet. So in other words, they just create.
They'd have a capital loss. They have all transactions balance. So when you're doing double entry bookkeeping, the assets might the debit and credit balance each other out. So when they first purchase bonds, and they're trying to inject money into the economy under QE, then they're paying a higher price for the bond than would otherwise be paid on the market so that they can buy it. So it's a higher capital cost. When they then later sell that bond back in, rather try to reverse the operation with quantitative tightening, so they're now selling the bond, they've got to sell it at a lower price, so there's going to be a capital loss between the two. But they can absorb as much as they like of those losses. And like at one stage, you might remember the British government saw the Bank of England was in negative equity and gifted them some bonds. So the government's, and this is the analogy I've just actually worked out. I gave this talk at Jeremy Corbyn's conference just recently. The way to think about the government versus the non-government sector is a seesaw. Because the financial system, if a financial asset is somebody else's financial liability, so the sum of all financial assets and liabilities is zero, just like the average height of a seesaw never changes. Okay? So one side's up, the other side's down. The government needs to be in negative equity to enable particularly the non-bank non-bank private sector to be in positive equity. So rather than saying it's bad for them to do this sort of stuff, being in negative equity, if they're not, it drives the non-bank private sector into negative equity. So it's a good thing that the government does that. So it's, again, Conway's thinking is still too close to conventional thought. It's time he actually did as good a study of the banking system as he did of the physical world in his book Material
But
World.
aren't central banks in negative equity ever?
They can be. It's normally the Treasury that ends up in negative equity.
Are they ever? I mean, do they believe that's a good
yeah, well, there's been certainly the British, the central bank of the Bank of England was in negative equity, I think, just shortly before COVID. They may have actually been negative during COVID itself. It's a transient state for them because fundamentally they're conduits for what the Treasury does. So when you do the double entry bookkeeping, the standard impact of a government running a deficit is the Treasury is in negative equity. The central bank tends to be neutral. And then because the Treasury is in negative equity, the non-government sector is in positive equity.
Yeah.
But it tends to be the central bank tends to be a conduit for that rather than the actual accumulator of negative equity.
And why this crazy thing that when the central bank holds bonds, they're still getting the coupon paid by the Treasury? I mean, what's the point of that?
Oh, that varies. That varies from country to country. I'm not sure of the actual pattern, but the situation is either as the Treasury stops paying interest on those bonds, or the interest is paid to the central bank, which then remits it back to the Treasury at the end of the year. So those are the two arrangements. There's no such thing as a black hole. There are individual black holes, but collectively, systemically, no, there isn't. So if one element goes down, somebody else goes up in terms of financial equity. So the central bank doing operations like this could drive it into negative equity. That causes a positive equity impact on the people it's buying from, and this is one reason Conway's reasoning is wrong. If the central bank is doing that, it's creating positive net worth for the party on the other side of the transaction. So the private sector ends up being better off because the central bank's in negative equity.
Right. So I'm still trying to figure out whether you think that QE is a good thing or a bad thing. It seems like, I mean, it's bad in that it can create asset inflation. I understand that. But we got it for different reasons, didn't we, during the pandemic, because we had no choice. So now you've got all of these large balance sheets sitting with central banks, and this desire to run them down, which we're saying there's no reason for them to do that. But can they do it strategically? Can it be another form of monetary policy that if they were doing it right, it could actually be another way of controlling the money supply and controlling the economy rather than always having to use the heavy instrument of interest rates?
It's possible to rearrange it in that sense, but the main lesson that comes out of all this is that the mythical model that neoclassical economists had argued the interest rate was the control variable for the economy to give us stability. Well, so much for that. This has been the most, I can't blame the pandemic on central banks. I'm sure some conspiracy theorists could. But what it meant is we've had instability, and it's really the Treasury that matters. So the Treasury's actions are the ones which we need to consider properly and see what it can do. The central bank largely should just be a conduit for what the Treasury is doing. And the idea that an active central bank is a major part of managing the economy, it isn't. It's the only thing they can actually do, because they can only deal with financial institutions as they're currently constituted. Then everything the central bank does boosts the financial sector or pushes up or down asset prices. It doesn't have a direct impact upon the real economy. If you want to have that, it's the Treasury you turn to.
But it does have an influence on interest rates, doesn't it? And it could...
Yeah, of course it sets the interest rate.
But it's not only sets it, but now, I mean, so for
it,
example, the Fed, there's talk about whether the Fed should have more of a focus now rather than just on controlling inflation and controlling interest rates. Because the interest rate they try and control, obviously, is the overnight rate. So it's the sort of like the immediate rate that is dealt with by the bank borrowing. But they could have more, through open market operations, have more control on longer dated deals, which is what they're talking about.
Well, that's what the original quantitative easing was literally doing that. They were trying to keep rates down across the entire spectrum. Yeah. So they were specifically buying bonds of particular date durations, not just buying for the overnight market. They were trying to target the entire yield curve. Now, at a certain distance from immediately. A certain distance from short-term bonds, the power of the buying and selling on the bond market can be a major force that the central bank has a hard time reversing. But in the short-term rates, it's got almost perfect control over what the rate is. And they have there used to be a guidance window about 0.25% above or below the target level. That's when they'd buy and sell assets to try to maintain the interest rate at that level. They don't have fine control over the extreme end. In terms of 30-year bonds rather than 30-day bonds, but they have complete control to control the short rate. It's then a question whether the short rate is above or below the long rate, the yield inversions and so on. So they can do a certain amount, but we've had an exaggerated opinion of what central banks can achieve because all the predictions of their effect on the economy are based on dynamic stochastic general equilibrium models in which the interest rate is the only variable that matters. So, stop pandering to the buggers and let's go back to when fiscal policy dominated what the economy did rather than what the central bank thinks it's doing in its toy models.
I think they're thinking about the 30-year was that because basically they don't have any control over it. It is driven by things like sentiment, for example, about how things people see the future. And if they're pushing yields up, if they've got less interest in buying those 30-year bonds, then the yields are going to get higher, and then that pushes up interest rates, and that pushes up mortgage rates, etc. So a lot of the economy is not based on the immediate interest rates; it's based on the 30-year rate. So understandably, central banks start saying, "Well, we should be controlling that too." But then you start to get into a situation where you go, "Well, okay." And just how much control is the central bank having here, and how much is it trying to run roughshod over, for example, the government's own, as you say, fiscal policy, which is what counts. So we are back to the situation where they're possibly fighting against each other or supporting each other. In which case, why have independent central banks?
Yeah, I mean, a large part of it, the economists who run the Treasury policy. Don't have complete control because politicians will dive in and decide what spending levels apply frequently. But they've got the same mindset as the people running the central bank. And so they both believe fiscal policy is ineffective. There's actually policy papers, academic papers with that title, the Policy Ineffectiveness Proposition, PIP. And that's what's believed by anybody who swallows neoclassical thought uncritically, which is all neoclassical economists have done that. So they basically, fiscal policy should be zero. They're all trying to target zero deficits or even better surpluses, as you can see the IMF's recent advice to Italy, and leave it all to the central bank. So they're supporting each other at the moment, but supporting each other with a fallacious model of how the economy operates. If we had realistic ones and saw the government creates money when it runs a deficit, and that's part of what should enable a capitalist economy to function well, because the deficit for the government creates an identical surplus for the non-government sector, we'd have better policy if we could get rid of the neoclassical economists.
But we'd be in a situation.
Unfortunately, they're stuck like barnacles to the ship of state.
Well, yeah, they definitely. Well, they have to survive. We're not advocating anything too extreme here, are we? But if you've got
they could go and we could give them an island somewhere in the Pacific to manage. That'd be fun.
I
hidden rose vacant.
Trump
at the moment.
supporters as well. I do think on the whole Trump thing, we should be saying everyone who supports Trump in England should go and live in America, and everyone in America who doesn't support Trump should come and live here. We should just do a swap and just see how.
That's not a bad
idea. How they get on. We could include a few from the finance sector in that as well. But if we got to a situation where we said, well, okay, first of all, governments have to run a deficit for the economy to grow. Just as fact that means that bonds are going to be issued. We don't want those bonds to find their way into being bought, or not all of them anyway, being bought in the private sector, because that will negate the money that the government's just created. So it has to be bought by the central bank. So then you get back into the situation where we saw during the pandemic. Do you remember once or twice we'd have an announcement from the central bank saying, we are going to buy another, whatever it is, 200 billion in government bonds, and then all of a sudden the Treasury miraculously half an hour later said we're going to be issuing 200 billion. I mean, there was clearly no independence. It was very transparent then, but it sounds like that's the sort of what you're talking about. Government, central bank just buys
fundamentally
right, but
realizing the role of the central bank as a conduit for Treasury policy. That's what it should be. I mean, one of the real issues, and I can't deny this one, is that letting politicians decide what spend money on gives you pork barreling, or bombing other countries, for example.
Yeah.
So there's a strong argument in terms of taking the power away from the politicians, but not in giving it to the central bank.
Right. But, okay. I mean, if the government creates money, it doesn't have to decide how to spend, of course. There's... Anyway, yeah, I'm trying to figure out what you're saying there. But I mean,
well, what I'm saying basically is we should have we need, in effect, we need to make deliberate decisions about where the amount of government money to create, and what that money should be spent on. And it's things like, health, welfare, infrastructure, the stuff that China's spending its money on these days, rather than bombing Iraq or bombing. Well, take your pick. I mean, I've given up on counting how many wars there are on the planet right now. But yeah, it's the governments quite happily bomb the hell out of Palestine, or they donate bombs to bomb the Russians in Ukraine, but they don't provide medical care, and they don't provide infrastructure and education. So you need a way to take this out of the political realm, which would mean having a citizens' assembly, the sort of stuff that a range of political parties in the UK are trying to organise right now. So it's not a decision of politicians of where the money gets spent. And that's the good point that they have in terms of saying you wanted to have central bank independence. We have a failed political system which is leading to the misuse of the government money creation capability. So I'm just wondering, is there a way of getting the control out of the politicians but not handing it over to the economists?
Yeah. But I mean, if we're talking about all the central bank is doing is buying up the bonds that the government issues, however that money from the government is spent, I mean, is there really any point?
Oh, it's still the politicians make the decision about what the money's spent on. So they're going to send bombs to Israel rather than fixing potholes in Clapham
all of that
Street.
aside. But however that government money is spent, if all we're doing is we're saying, well, okay, there's a government deficit, however for whatever purpose. And we can argue in another edition about how effectively that could be spent. But there's a government deficit. The central bank buys it all up so that it doesn't go back into the private sector and negate the impact.
Yeah,
there really is no point in having a central bank, that is, because the Treasury could just do that all by themselves, couldn't they?
Well, this is the way MMT theorists collate the two. I think it's always important to see what the accounting is, so I keep them separate in my approach using Ravel and the way I model the system. But the central bank should just be a conduit that's and setting interest rates not based on neoclassical theory about inflationary expectations, but real information. Take inflation decision making away from them, put it towards the Bureau of Labour, is argued by Isabella Weber. It's just that they don't have the control they think they do. So they're playing with a toy set of controls and think they're managing the economy. But largely I'd go to the central bank should be fairly much just a conduit. It shouldn't be a policy-making body. At the moment, we've got a policy-making body with the wrong people in charge.
So you just need a good administrator called Norman, who's quite good with figures.
Yeah. Okay.
As the
Norman Pockets.
Yes. My name's Norman Pockets. I do all the administration for the central bank. It's just me and Gertrude here, who makes the coffee.
And that's all you need. There we are. There's the new form of the bank.
That's what we need. Yep.
All right. Very good. Okay, we've got that one sorted, and we'll see if it flies. Good to talk, and look how beautiful it is. I'm in Sydney for the next few weeks, so get used to the view.
With a bit of echo in your studio, I might add. You've got to put.
I know.
You need some baffles there.
Yeah, I know. Oh well, you're gonna have to live with it for a few weeks. Anyway, we'll catch you next time. Thanks, Steve.
Okay, mate. Bye.